Hello everyone and welcome to More Fun with Fitzy. Today we are actually going to analyze changes in financial position. This is where the course gets really good. I really enjoyed this and I hope you will too. Okay, we're going to be looking at something called an equation analysis sheet. So here is an example of a balance sheet. This is Metropolitan Movers balance sheet as of January 31st, 2008. We are going to set up the transaction analysis sheet, or sometimes it's called an equation analysis sheet. Okay, so both of those words can mean the same thing. And we're going to set it up with the beginning balances as per our balance sheet. Okay, you will see here, across the top of our equation analysis sheet, we have our assets, and they're listed in order of liquidity. We have our liabilities, and we have our owner's equity. Okay. Just like it shows here. This is how we set up the beginning balances on the equation analysis sheet. Normally these squares are empty and we're going to take the amount from our balance sheet and we're going to put it onto the equation analysis sheet. Okay, very straightforward. So you're going to go down your balance sheet, take each of those amounts and put them in the correct spots. And if you look at this, your fundamental accounting equation should always balance no matter what. So if you add up your assets, they equal $53,300. If you add up your liabilities and your owner's equity, $20,000. And sorry, our owner's equity got pushed down here, but those two together add up to $53,300. So your fundamental accounting equation should always balance. Okay, so we are going to do transaction by transaction here. And businesses are all about transactions. In this case, Metropolitan Mover pays $1,200 cash to Mercury Finance. And Mercury Finance is a company in which we had a loan. Okay, so in this particular case, remember here in this row, we set up our beginning balances, and here is the first transaction. So this is transaction 1, and we're going to put it here. So we paid $1,200 cash, therefore our cash went down. So we're going to put a minus $1,200 here. And if you take that $1,200 from the $13,500 we originally had, that'll give us $12,300. Nothing happens to accounts receivable, it stays the same, so you just put it down in the new balance row. Here, this row is for new balances, so on. But the other thing that was affected was Mercury Finance. We no longer owe Mercury Finance, so our loan also goes down by the same amount. Remember, every single transaction you must affect, I'm going to write this down, you should write this down too, must affect 2 or more accounts. Always. This is called double entry accounting. Okay, and nothing happens to capital here, so we bring the same amount down. So the only two things that changed here was Mercury Finance and our cash. Our cash went down and our loan to them went down. If you were to do the fundamental accounting equation now, guess what? It still balances. Every single time it should. Here's our second transaction. K. Lincoln owes Metropolitan Movers $2,500, pays $1,100 of that. So that means our cash goes up $1,100. Here it is here. We just received $1,100 from them, and they no longer owe us that $1,100, so that account is going to go down. Our accounts receivable has gone down. Okay, $12,300 plus $1,100 equals $13,400. Nothing changes here. $2,500 minus $1,100 equals $1,400. Nothing changes here. Nothing changes here, and so on. So our fundamental accounting equation, if you add them all up, still balances. And we've affected 2 accounts or more. Always remember, you have to affect 2 accounts or more. Here's another transaction. Equipment costing $1,950 is purchased for cash. So our cash went down $19.50, but our equipment just went up $19.50. See that? So again, to get our new balance, the 13,400 minus the 1950 equals 11,450. Nothing changed here. Nothing changed here. But our equipment went up. So 11,500 plus the 1950 goes up to 13,450. Make sure you use your calculator or do this very carefully, because if you do one mistake, your whole equation analysis sheet will be wrong. Nothing changes, nothing changes, nothing changes, and nothing changes. We just bring down our balance here. Again, the fundamental accounting equation still balances. Okay, our transaction, our fourth transaction, a new pickup truck is purchased at a cost of $18,000. We paid $10,000 cash, and we borrowed the rest. We borrowed the balance from Mercury Finance. So let's take a look at this. We bought a pickup truck for $18,000. Let's make sure we put our pickup truck for $18,000 right here. Our truck went up. But we didn't pay the full amount. We only paid $10,000 in cash. So that $10,000 of our cash goes down. But so far, our fundamental accounting equation won't balance, because we have, on the left-hand side of our fundamental accounting equation, we have it going, if we take away the 10,000 from the 18, we have a positive 8,000, but our right side will be down 8,000. So remember, we still owe 8,000 here. Okay, so remember I said 2 or more accounts. Always. So in this case, there were 3. We bought a truck for 18,000. We only paid 10,000, but we also owe 8,000. And now that we have the 3 accounts affected, our fundamental accounting equation still balances. Okay, let's try transaction 5. Metro Movers completes a storage service for BKva at a price of $1,500. And a bill is sent to BKva. Okay, so they provided the service, they did not receive cash. Okay, so in this case, BKva is an accounts receivable. They owe us money. They owe us $1,500 now, because we just provided a service to them and they owe us the money. Cash didn't change, equipment didn't change, trucks didn't change, nothing changed about liabilities. We don't owe anyone any money. So our capital went up. When you provide a service, your capital goes up, which is great for the company. Okay, so nothing changed in cash, so our balance still remains the same. However, our accounts receivable for BKva was $1,300, and we just added $1,500, so now it's $2,800. Nothing changed here, nothing changed here, and so on. But here, we're going to add this $1,500 because our capital went up to the $33,180 to get this amount. Our fundamental accounting equation still balances. Last one, I believe. The owner takes $500 out for his or her personal use. Okay, so here, cash from the company. Remember, this is the company's cash. Company. The company no longer has the $500. And therefore, if you were to do your fundamental accounting equation, the owner's equity would go down because nothing else changes. The owner took money out, which means the capital, the owner's equity goes down. Okay, and you know the math now. 1,450 minus the 500 equals 950. No change, no change, all the way across, no change. And here, 34,680 minus the 500 equals 34,180. Remember, be careful. And again, our fundamental accounting equation remains the same. I challenge you to make sure this balances after every transaction. Oh, one more, I lied. One of the trucks requires engine work that costs $75. We paid for the repair in cash when the truck is picked up. Okay, keep in account here, nothing happens to truck. You did not buy a new truck, okay? But you did pay $75 for a service. Your accounts receivable doesn't change. You're not getting any money from anyone. Your equipment didn't change. You did not get a new truck. accounts payable and your loan didn't change, but when you pay for an expense, your owner's equity goes down. Okay, so we learned that it goes up when you provide a service, and it goes down when the owner takes money out and you pay for an expense. And again, our fundamental accounting equation still balances, and if you don't trust me, add the 34,105. It's down on the line, you can't see it here. At the end of an equation analysis sheet, when you're done all the transactions, by the way, equation analysis sheets are not typically used in accounting. We're just using this as an exercise to get used to transactions, to make sure our balance sheet will still balance after every one of them. Okay, after the equation analysis sheet, our very last line, after all of the transactions, I want you to take all of these amounts and make a new balance sheet. So the balance sheet's going to look almost identical, except for the numbers will change. And you need to make sure that your balance sheet still balanced. And we're missing our word total assets here. Oh, so it's going to go through and show you just like I did. So we'll skip all those. Really quickly for transaction review, the first transaction, we bought supplies for $50 cash. So think about it. What happened here? Cash and supplies. Supplies were bought, so that means they go up, and cash was used, so it goes down. This is wrong. I promise you, cash decreases and supplies increase. Each time the fundamental accounting equation should balance. And that's it for now.